Hello and welcome to this week's edition of Think Big. I am your host, Akia Garnett, and I am excited to be joined in the studio by my friend and truly a business expert, Anthony Stewart, who is the CEO and founder for Stewart Financial Services. I met Anthony several years back, and we've done some things together. We did an event together, and that event really inspired a lot of dialogue around this whole concept of saving middle America. Anthony is also the author of a book. He's co-authored with a couple folks called Saving Middle America, and we'll talk a little bit about that during the show. So without further ado, hey Anthony, how are you?
Hey, I'm doing good. How you doing?
I'm all right. I think I'm coming down with something, so.
Oh, don't feel bad. I had a bad sinus day today too, but I'm much better now.
Right. Tell us, Anthony, tell us about your line of work.
Financial services is not something that I grew up wanting to do. I just kind of fell into it because I needed some financial help. And it's actually a fraternity brother of mine that told me I should get involved with it. And from that point, I started off part-time for a couple of years and did it part-time, left the corporate world, and been doing it full-time ever since July of 1993.
Wow, so you said you just found your way into it.
Yeah, I didn't, like I said, I didn't know what I really wanted to do, but
Okay.
I knew there was a big need for it. I figured if I needed help, and I thought everybody else that I knew also needed help.
Right.
And then as I began to study the industry a little bit more and realize that middle America really needs the help, and that's what our primary focus has been over the last, almost 25 years now.
Right. I mean, personally, would you say that you learned financial literacy the easy way or the hard way?
I had to learn the hard way. I had to learn the hard way and made some mistakes along the way. And I just wanted to make sure that other people that I came in contact with didn't make the same mistakes that I made.
Wow. Well, thank you very much for that. So what exactly are the lines of services that you offer?
We do retirement planning. Our specialty is tax-free retirement. We do mortgage protection. We do rollovers when people leave a job. They don't know what to do with their old retirement account. We do the new kind of life insurance, which
Okay.
I'm really excited about that. We do final expense. We do a little bit of long-term care.
Okay. I want to break down each of those
Okay.
because I know a lot of people just get confused about, all of those things, especially when you say the new, what did you call it?
The new kind of life insurance.
Yeah, the new kind of life insurance. That's definitely something that we need to talk about. So when it comes to insurance, what are some basic things that people tend to confuse around that entire concept?
Most people don't know what they have a lot of times. There's really only two types. Either you're going to rent the coverage or you're going to own the coverage. People get get confused with term insurance.
Right.
Term
That's
just
at 30
means you're
years or
renting
something like that, yeah.
20, 15, 30 years. You're renting the coverage. And less than 2% of them ever pay out because most people outlive it.
Right.
So now they're without coverage. And hopefully their health hasn't changed. So the other thing is just get something permanent where you own it.
Right. So when it comes to the, living longer, people are living longer nowadays. What are their options then if they are outliving the term?
Well, they have to get something permanent. And actually, they really should be getting something permanent early on.
Right.
Because
so
when it comes to
are you saying just do away with term as a whole?
that's just my personal opinion.
Okay.
Because there are so many tax advantages that most people are unaware of.
Right.
And the wealthy people have been using these things for years, and we just got to get on board with what they're doing. In fact, the government has laws that are favorable to this stuff. So those are the kind of things that we share with our clientele.
Right. So then if the person does have term and they've been in it for a while, I mean, do they have any options after they're getting close to the end of that? What can they do?
Well, hopefully they can convert it to something permanent if
Okay.
they have the right kind. All term policies are not convertible. So in other words, it only works unless you die. So if they got to one where they can convert it to something permanent, and a lot of times you can do that without going through the insurability part again,
Right.
which is really most important.
Well, let's talk about some of those permanent options that you mentioned instead of term.
That's whole life, which is the oldest kind, which is also the most expensive. Then you have universal life, which the premiums are flexible, it costs a little less. And then you have what we call index universal life. That's where you can take the advantages of the Standard & Poor's or S&P 500. It builds up cash much faster, and your premiums are still flexible. So that's pretty much what the newer people are doing today.
Right.
Because a lot of people don't have a retirement plan, so they're using this as a way to save money and pull it out on a tax-free basis. It has really changed the whole surface of the way people look at insurance now.
Okay. I mean, how do you help people start from square one? You know, especially people who may not be financially literate at all, and they may not be aware of any of the terms that, you know, you may use on a regular basis.
Right,
Where do you
right.
start people when they just come to you and say, I don't know what I need, but I know I need something?
Okay. Well, it all begins with teaching them how to build their financial house. That's where it all begins. And if you look at the house you live in, the first thing that went down is the foundation.
Right.
That's the most important part of the house. So when it comes to financial planning, it all starts with the foundation, and the foundation is life insurance.
Right.
And we pride ourselves on making it simple. Either you're going to rent or own, and it's really just that simple.
Okay.
And so the main thing is get what's in their budget.
Right.
That's the most important thing. And people always ask me, well, Anthony, what's the best policy? I said, the one that was in force the day you died.
Right.
That's the best policy.
So, and when you say get something that's within their budget, you're traditionally working with folks who are employed by someone else, or are you also working with small business owners who might be looking
Both.
for options?
Combination of both. We do a lot of seminars and stuff in the federal government and churches. So we're dealing with all spectrum. We're dealing with people that are just beginning.
Right.
We're dealing with people that have been in the workforce for 30 to 40 years. So we deal with the whole gamut of that. So we don't just target just the young folks. Everybody needs it.
Right.
And we don't discriminate based age. So if you're 55, 60, it doesn't really matter. You still got to understand the same things.
Right. Is there a minimum amount of money that you need to invest in order?
As far as insurance?
Yeah.
You can get a program for as low as $25 or $30 a month. That's
Right.
the best thing for your budget.
Right.
Some coverage is better than none. I learned this saying years
And that would be
ago.
not term, but that would still be like something more
It
permanent.
depends on the age. You know, people get hung up in the amount. You got to do what's in the budget.
Right.
I always believe this. A little bit of something is better than a whole lot of nothing.
Right. I could not disagree with you at all on that. So let's just back up a little bit and talk about Stewart Financial Services. Tell us about how long the business has been running and the ways in which you're going out and educating people, but also servicing them.
Yeah, we've been in business now almost 25 years.
That's great.
Based out of
Congratulations.
Atlanta, Maryland.
Yeah.
We are committed to be a company not just to educate, but really have some fun. I'm at the point in my life now, I don't want to do anything unless I can have some fun with it. And the people that we bring on board to work with us, those are the kind of people that we want to attract. People that want to have fun, but also understand the seriousness in what we do.
Right.
So we don't look for people that just want to be here to make a quick dollar and go somewhere else. Most of our agents have been there over 10 years, and that's unheard of in this industry.
Right. What does their job look like?
They basically go out and do the same things that I do. They go out and present workshops. They deal with clients on a daily basis.
Right.
They deal with children, juvenile coverage. They deal with rollover. They do the same things.
Right.
So in about 90 days, most of the time, we can get a person up and running, and they could be out here servicing people and putting money in their pockets and also doing what's good for the client as well.
Right. And then this great book that you wrote, Saving Middle America, and I know you co-wrote that with a couple folks. Tell us about that, the foundation of that book, the focus of it, and you know what you hope that it will continue to do.
Well, number one is education. My other business partners, Barbara Cavage, Richard Ross, we got together and wrote the book. And basically what we did was put all of our years' experience together in a book. And one of the things we wanted to make sure was happening, we didn't want to talk in some high language that people didn't understand.
Right.
It looks good, but it doesn't make a difference if people don't understand it.
Right.
So we wanted to make sure we got that message out clear. I particularly wrote chapter number 4 as it relates to African Americans and how we really got to get on the ball because we got to deal with different elements a lot of times as it relates to our health.
Right.
So we talked about the importance of starting early. And it's really never about how much money you save. It's really how long you do it.
Right.
And that's the main message that we wanted to get across.
So trying to get people to save longer,
Right.
even if it's just some smaller amounts of money.
That's right. And it can be a smaller amount if you start early.
Right.
The problems that we see is people start late. Now we can't talk about $100 a month. Now.
Right.
You're already 53, 54 years old. You're
Right.
starting late.
Right.
So you have to put in a lot more. The other problem I see is because a lot of times we start late, we chase the higher returns.
Right.
And not realizing their higher return, the greater the risk. So we got to be aware of that.
Right. So what did you particularly find when you started to do even more research on the African American community and our saving habits and the things that we've done okay with over the years.
We're
and the
getting
things,
better.
Yeah.
We still have a lot of work to do, but we are getting better from what I see. I still see younger people wanting to start earlier, and then I still see older people realizing that they should have started earlier,
Right.
and now trying to make up the ground from which they lost.
Right.
So there is improvement, but we still have a long ways to go. We still have a lot of work to do, and we're willing to roll up our sleeves and continue to educate and do the best job we can.
Okay, and most of those packages are these when that they're benefiting from them, or they're beneficiaries after they're dead, or are you also working with them on things that they can borrow against in the future? And
Absolutely. I mean, that's what the permanent coverage does, where they can take out money. In other words, we're teaching them to become their own bank.
right,
And there have been several books that have been written about this, where you borrow from yourself and you take the money out on a tax-free basis.
right,
One of the things that makes us a little different is we focus on the real issues, and nobody's really talking about taxes.
right,
Taxes will become the single biggest obstacle that prevents us from creating wealth. So we got to learn how to buy out Uncle Sam. And those are the things that we teach in our workshops, how
Right.
to really do that.
and you talk about this tax-free retirement thing. What does that look like? What is that?
Well, there's only a couple of ways that you can save tax-free money. One of them is a Roth IRA. The other one is certain types of permanent life insurance. So you got to get as much money in the tax-free buckets as you can. So we just teach people how to do that. Most people are saving tax deferred, which is okay, but you
Right.
still got to pay the taxes on it in your 401ks, your 403bs. So we got to get some tax-free money.
Right. And this program that the various programs that you're talking about, how do you even help people move their assets and so forth over in that direction? Are they penalized when they do so, or?
Well, if they left a 401k plan that's rolled it over into another IRA, there are no taxes right now. But it's still, that's like, we can't change that. Uncle
Right.
Sam still wants his money
Right.
when you pull it out. But they are direct rollovers where you don't have to pay the taxes now.
Okay. And when you all were defining middle America, what and how did you define that? Because it just seems like such a broad term now.
It is, and that's the biggest class that's underserved. In other words, we're not looking for people that's already millionaires. We're not looking for people below the poverty line. That gap is middle America.
Right.
These are the people that are working and coming home that can save $200 to $300 a month. That's middle America. So that's the bigger class, as opposed to focusing on the wealthy and the people below the poverty line.
Right. And when you say saving middle America, then the goal was to help middle America actually save more, or to help middle America not go away? Because when I hear saving middle America, I think there's something that's at jeopardy.
Well, I mean, if we don't change some of the things we're doing now, things are going to get worse before they're going to get better. That means we just got to start teaching people the importance of saving now. We got to teach people to get basic life insurance. There are so many people that don't have insurance at all.
Right. Do you have any statistics on how many people are just not covered?
According to the LIMRA studies, 50% of Americans don't have insurance. Over 60% are underinsured. Most people only leave enough life insurance to replace their income for 2 to 3 years.
Right.
And it should be 10 years or more, in some cases even longer. So that's a big job to do just on life insurance alone.
Right. And so you're out there and you're doing seminars and so forth. What kinds of topics are you teaching in the seminars?
We teach anywhere from budgeting to college planning to understanding life insurance, the power, the purpose, and the tax advantages.
Right.
Disability income. A lot of people are not protecting their income. You know, if you take a breadwinner out of a household, that's going to increase the foreclosure rate.
Right.
So people have to learn to protect their incomes. And that means that you got to have enough money set aside where if you can't work, the bills don't stop coming.
Right. So your
So there has to
short-term
be money.
disability is what you're talking about. those are-
Short-term, long-term disability. I've seen that happen where people lose their homes because the breadwinner's sick.
Right.
So
Wow.
we got to be prepared for that.
Wow. And those seminars, they one-day seminars, especially when you talk about budgeting. What are some of the key things that you cover in budgeting? Because I wonder if it's an income issue with many people, or if it's just a budget issue with many people.
I think it's a budget issue with many people. And let me tell you why I say that. It's prioritizing.
Right.
One of the things about budgeting, I'm not saying none of this is easy,
Right.
but learning to understand your wants versus your needs, understanding what you need now and stuff that you can do without.
Right.
And we don't get in trouble on our fixed expenses. We know how much you pay for your mortgage, your car note, or whatever. Where most of us get in trouble is our variable expenses.
Right.
Eating out, shopping, going to shows, and all those things.
Right.
That's where we get in trouble, not on the fixed expenses.
Right.
So if we learn to put ourselves at the head of the line, we work to get that check, and we pay everybody else first, and we give ourselves what's left over.
Right.
We got to put ourselves at the head of the line, because Verizon, your car note, and all these other people aren't going to send you a check when you get old.
Right.
So we got to put ourselves at the head of the line.
So putting ourselves at the head of the line means putting something away for self. Is that what
First.
you're saying? Yes.
Before
Versus
we
that
do all this
disposable
other stuff.
income thing.
That's
So then
right.
that means you have less disposable income.
That's okay.
Yeah, I'm not saying it's a problem. I'm not saying it's a problem.
Right.
Right.
It's a thing where either we're going to pay now,
Right,
so
or
that
later.
we can play later,
Right.
or we're going to play now and pay later.
Right.
One of the other.
Do you have any stories that you can share on someone who kind of got it right? They've done a really good job with their portfolio, and it really, goes to show of how they're playing today.
And the young lady started way back when she was 18. I met her at a beauty school in Lanham, Maryland. And we talked, we got a plan together. And to this day now, she's married, has bought a couple of homes. And it all came from her becoming her own bank.
Right.
She did never have to go to the bank and take out a loan. She had enough money in her policies
Right.
to borrow from her own self. And it's good to see that. You know what I mean? Now she's teaching her children.
Right.
Her daughter now is 21 and now has sat down with me and got something started.
Right.
So I love to see those kinds of stories.
But I mean, it's something when you start to talk about African Americans and some of the challenges when it comes to financial literacy. A lot of it is also, generational, where you just aren't able to pass any knowledge down about financial management. And so it just continues. Their cycle is just almost forever. How are you breaking some of that? Because it sounds as if you are.
Well, the thing is again, is education. And I think doing these workshops is really a part of it. The other thing is making it simple for people to understand.
Right.
I mean, in plain and simple language. I think that's really the key. And just never giving up with the message. One of the things I pride us on, our message is the same. We don't get off path too much.
Right.
The message is the same. You got to start early, and it starts with the same order: insurance first, emergency money second, retirement. Then you could think about retirement.
Okay.
But then we got to think about the what ifs. What if I get sick? What if I have a heart attack? What if I have a stroke? That derails all that planning.
Right.
So we got to do all this stuff in the right order, and it has to be consistent.
And what about insurance policy amounts? How do you help people determine what's enough?
Well, put it this way. I've never had anybody say, you know what, this was too much money. I'm sending some of it back to the insurance company.
Right.
I've never heard that happen.
Right.
But it kind of basics is at least 10 times your income. And in some cases, that may not be enough. If you got a spouse and children that are dependent on your income, it's called the dependency time period. So that husband and wife had to sit down and say, if I were to die tomorrow, how long does my wife need my income to carry out my family goals? So then we got to compute college. We know college is going up every year.
Right.
So by the time a child is born now, it's going to probably cost them over $300,000 just to go to college.
Absolutely.
So if you got 2 kids, that's over $600,000.
Right.
A $250,000 policy won't do that.
Right. I mean, one of the things when it comes to talking about life insurance is the whole concept of death and people being afraid or spooked out to even talk about that. How do you get around that so that people feel comfortable even? It's like talking about a will, your last
Right,
will and testament
right.
or power of attorney and all of those things. I mean, it's just not things that people feel warm and cuddly about,
I understand. But guess what? One day we all going to die. And we know that.
Right.
But if you get the right kind, it's not about just dying. That's really the small part.
Right.
The big part is building up a nest egg of tax-free money. And you can do that inside of a permanent policy. The other thing is, if you got the right kind, something that the person that's buying it feels that they can use. You remember, we all listen to the same radio station,
Right.
WIIFM. What's in it for me? So you got to get something now that has what we call living benefits.
Right.
Well, it has terminal illness coverage, chronic illness coverage, which is pretty much like long-term care. Critical illness coverage that covers heart attack, stroke, cancer, plastic anemia, cystic fibrosis, critical injury coverage. If you get a plan with all of that, and all those things I just named are automatically included, people feel different about it now.
Right.
So now it becomes a want sale versus a need.
Right.
So people will gladly knowing that it's more than just leaving a death benefit.
Right. Correct. I mean, and for the actual things that you mentioned, how long does it actually take for a person to be fully vested? I mean, do you have to be paying into it for a long time before you can actually reap the benefits?
Well, with any insurance plan, you could buy a policy today. You die next month. Once they do all the background checking, they have to pay the claim. That's the fastest way to create your net worth.
Right.
But as far as the other living benefits, in most cases, you have to have the plan at least 30 days. In some cases, 90 days before you can use critical illness and things of that nature.
You know, things change often too when it comes to laws and codes and so forth, taxes and codes.
Right.
How do you stay on top of everything?
I do a lot of reading. I attend a lot of training, and that's one of the things that we require from our agents. Most of us belong to an organization called NAIFA. That stands for National Association of Insurance and Financial Advisors. We go to those trainings a couple of times a year. Each insurance company has their own individual training. So we really want to stay on top of that, so we're on top of what's really going on in the industry.
Right. And when you said earlier that, you know, some people just don't even know what they have, do you have any tips on how a person can just sit down and look at their actual policies and pull out, you know, some high level things?
Well, the month of September is Life Insurance Awareness Month, but in our mind, every month is Life Insurance Awareness Month. So people just have to review their stuff. And we offer a free review, a free policy review.
Right.
And people just have to pull it out and just take time to go over it. Now, I don't expect them to remember every little detail. But the worst time to find out what you had is when someone passes away.
Right.
So every year or so, we encourage our clients. We have a client appreciation night a couple of times a year when we invite our clients in and we go over what they have.
Right.
We give them a quiz and see what they remember and give away door prizes.
That's
so we
right.
make it fun.
Yeah.
So they know what they have.
Right. Do you think that they are doing a good job at trying to incorporate financial literacy in some of the school curriculum, even as early as elementary school?
It's getting better, but it's still so much work to do.
Right.
I don't think they're doing enough of it. I still think financial literacy should be a part of even graduating from high school. If we don't teach our young people about money, then where are we headed?
Right. You said earlier that you also do a lot of workshops in churches and so forth. What are they calling you in for?
Financial literacy workshops. We have different titles. Some of them we call tax-free retirement.
Right.
The 4 steps to creating your own financial independence. Now we're doing one called protecting your retirement assets in a volatile marketplace.
Right.
So we have different titles of them, but a lot of it, the basics is the same, but we may incorporate other things into it.
Right.
But that's what the people want to hear. Churches want to make sure that people can budget.
Yeah.
Because if you budget, you can give more. But you got to live on a budget.
Right. I mean, the thing is, with the increase in entrepreneurship and more people taking that, you know, step toward working for themselves, sometimes those salaries may not be as high or their income may not be as high as if they were working for an organization that provided some of the benefits that, you know, we're talking about. How do you help people early on when they're going into business for themselves recognize some of the things that they need to do in order to secure their financial future?
Well, if it's a partner, if
Right.
it's a couple or whatever, that the first thing they need to get is key man insurance,
Right.
so that the business can keep going in the event one of the partners passes away. That's where it all begins. The next thing you need to do is get disability, because if they can't get in the shop or whatever and do the work, the bills don't stop coming. So those are just some basic things. And then maybe a couple of years on the road, you could really start socking away some money so that you can have a future. You can't work forever.
Right. And providing those services for their employees, you're helping them to also
Yes, if they want to do that, we can do that. We're not doing a whole lot of that yet.
Okay.
We do offer it, but a lot of times business owners think about just keeping the lights on.
Right, right.
But the good news is that they don't have to match anything. All they got to do is just make it available through payroll deduction.
Right.
And they still come out on top. You know, employees look for people that care about them
Right.
outside of the job.
Right.
So just being able to offer something like that is a big deal for a business owner.
All right. Stay right there. We'll be right back with more on Think Big. Welcome back to Think Big. I am your host, Akia Garnett, and I'm just excited because we're having a conversation about financial literacy, and this is a big thing that everybody needs to know more about. I don't think you can ever have enough information on financial literacy and what that means. Tell us about 401k versus 403b, what the difference is, and what people should know about that.
Okay, you know what? Here's how simple it really is. They're all tax codes.
Okay.
That's all it is. 401ks are for people that work in the private industry. 403bs are people in the educational system. Then you have the 457, those are like the state and municipal employees. They're all tax codes. The TSP, that just stands for Thrift Savings Program. That's the federal government's retirement system. So they're all tax codes. They all work the same. You defer everything. You defer the taxes.
Right.
But you have to pay the taxes when you pull them out. And that's where Uncle Sam steps in. I see Uncle Sam is our solid business partner.
Right.
He knows this. And it's funny we're talking about this because, the Roth IRA is, you can use that for retirement, but yet you can only put $5,500 in that one. Unless you're over 50, you have that other 1,000. But yet, in these tax qualified plans, your 401ks, your 403bs, 457s, you can put 18,000 in there. And I always ask my question, how come it's not equal?
Right.
And the answer is real simple. That's the government's revenue stream, taxes.
Right.
So, and if nobody doesn't believe that taxes are going to be higher in the future, we really need to wake up and smell the coffee. Because taxes, because of the debt that the country's in, for every dollar that comes in, 76 cents goes toward four major things: Medicare, Medicaid, interest on your debt, and Social Security. So because of that, tax is going to have to double at some point in order for the country to remain solvent. So the government knows that. So all we're really doing is delaying the pain when we dump a lot of money in these accounts.
Right.
And you know what? I'm going to give you a good analogy. It reminds me of, let me ask you this question. You're a smart lady.
Well,
Yeah, you are.
it depends on your question.
If you were going to buy a house and the lender says, Akia, here's your mortgage payment. Your next question would probably be, well, what's the interest on this loan for the house?
Correct.
And the lender says, I don't know, but I'll tell you at the end of the 30 years.
Okay.
Would you take that loan?
No.
Okay. But that's kind of in the sense of what we're doing when we pour our money in these tax qualified plans. We don't know what the tax complications is going to be. Isn't that scary?
That's very scary.
I mean, so
But
right
we can't
now,
do anything about it, can we?
we can't do anything about it.
Right.
Well, we can do
Well,
something
as
about
we
it.
can do, we can be proactive on. Yes.
We can redirect some of that money and put it in a tax-free bucket. That's what we can do. But we got to do it, though.
Is there still a gotcha at the end of that too?
Well, no, because you've already paid the taxes before you went in. And if you set it up properly, the money comes out tax-free through the proper use of loans and withdrawals. That's what the wealthy people do to get tax-free money.
Right.
It's not in the stock market. It's not in the 401ks. It's in tax-free buckets.
Right.
And here's the thing. If you set it up right, there's no limit as to how much you can put in
Really.
if you structure it properly.
So you don't have this 18,000 and 5,500 threshold that you mentioned earlier,
No, you don't. Not if you set it up right.
right? And what about pensions? Yeah, I remember pensions used to be the hot thing. People used to talk about that a lot. Never hear anybody talking about a pension anymore.
I wish I had one.
Right.
But here's the good news. We can create our own pensions. My thing about pensions is less than 11% of Americans have a pension now.
Right.
So for those who have one, I mean, you're in a good place. The pension is really nothing but a guaranteed paycheck for life.
Right.
But here's the danger now. You got to make sure your pension is funded properly. There are a lot of pensions that are not funded properly. Now, what does that mean in layman's terms?
Right.
You could be getting $5,000 a month, and then 10 years from now, or 15 years from now, or even next year, you could get a letter saying that because it wasn't funded properly, this $5,000 we've been sending you for the last 20 years is now going to be $3,000. So a lot of people's pension is not funded properly, and there's a report that they can request so that they can see how well their pension is funded.
Right.
The best example I can give you is the state of California. Their pension is underfunded. It's probably not going to last much longer. So that's scary.
So the people that are currently drawing their pension, they're just going to run out of money.
Well, they probably won't run out completely. They just may get a smaller benefit.
Okay. Okay.
They're not going to send it back,
Right.
but it's an adjustment in their lifestyle.
Right. And what about things on the East Coast? What are some things that people should be thinking about if they're living in Maryland or Virginia or D.C.?
I don't think it's a geographical thing. It's just really where you work. I mean, it's expensive to live here.
Right.
I mean, we have to save more money to live here, and we need to save it more tax-free.
Right.
We got to really stop chasing growth. You know what I mean? And that's what makes our firm a little different. Its income is the outcome that matters most at the end of the day. You know, not chasing the high returns and playing around with the market. Because a lot of times people get hurt by that. You know what happened in 2008?
Right.
I know people that lost $100,000, $200,000. Why?
Right. Greed, I guess. It was exciting.
Well,
That was exciting. That was an exciting time. People were pulling all kinds of money out of their homes and everything. I mean, it was nice.
People lost a lot of money in
A
2008.
lot of money and a lot of homes.
Yeah, but see, now they're trying to get it back. And unfortunately, a lot of America has forgotten what happened in 2008.
Right.
They forgot that the market lost almost 40%. And now the market is looking good now. We're in the 9th year of the longest running bull market in the history of our country. So the accounts are looking good now.
Right.
But what goes up
Must come down.
must also come down. The question this time is, are we going to get hurt by it like we did before?
What's your prediction?
It's going to happen. We just don't know when. And what we're trying to do is position as many people as they can where they won't get hurt by it. They could actually benefit from it if they get it set up right. So it's going to happen again. We just don't know when.
Right. For the people that you employ, where do you start them on the whole? Do people have to have some understanding of financial literacy before they work for you, or do you pretty much take them from square one and you can bring them
You
forward?
could take them from square one. I didn't go to school for this. I didn't know anything about this, but we provide the training. We provide the support. We start them off with doing the easy things. We don't start them off doing rollovers and all that kind of stuff yet.
Right.
We don't want a new person out there trying to talk to somebody about their life savings. But there are things that they can do and kind of graduate to that level. So we are looking for new people
Right.
that get involved in this business, and
Right.
it's a great business to be in.
So you talk about different accounts earlier. Is there some, formula in your mind on how many different accounts folks should have, or?
Well, it's nothing wrong with diversifying, but there's a time and a place for all this stuff. In other words, there's something called a retirement red zone. What I see a lot of times is people that are a year or so from retirement, they're still in the market.
Right.
They're still taking risk. There's something called the rule of 100. And the rule of 100 is whatever your age is, you subtract that from 100, and that difference should not be exposed to market risk. So if I'm 70 and I look at my portfolio, I shouldn't have more than 30% exposed to risk.
Right.
That's the rule of 100. Anthony Stewart's rule is, I don't think you should have none of your money at risk, because I've seen it over and over again. Moderate gains without losses will outperform a volatile market over time. So that retirement red zone is crucial.
Right.
The 5 years before you retire and the 5 years after you retire is not the time to be wasting money,
Right.
because that could change your whole retirement picture.
Right.
And I know a lot of people that lost a lot of money in 2008, and they're still working now.
Right.
It's hard to make up $100,000.
So those 5 years before retirement, you're saying that disposable income really is slim to none almost.
Right. They
Most
should
of
not be
it, you're
losing it.
banking most of it.
Right. It should be safe at this point. You know what I mean? Because there's a lot of risk now, and when it comes to retirement. You got the withdrawal risk. You don't want to take out too much money when you retire.
Right.
When I first got started, it was 4%. We should say you take out 4% and you'll be okay. But see, that was when people were dying in the 80s. See, people are living to almost 100 now.
Right.
So now the bulletproof rate is 2%.
So I want to make sure I'm understanding. So when you're saying 5 years out from retirement, you're saying that for their actual retirement portfolios, those should all be conservative in terms of what their buckets are.
That's right.
Versus so you're
continuing to take risk.
okay. So versus the moderate and the more aggressive end.
That's correct.
All right.
That's
So then
correct.
you're kind of clamping down all around the board, and you're saying, time to put it all down, and everything
right.
should be conservative. I'm not going to make a whole lot right now, but I'm also not going to lose.
You're not going to lose at all.
Uh-huh.
And again, not losing in some cases is winning.
Right.
You talk to somebody that lost $100,000 in 2008, and let's say they had $500,000 in an account, and they came to you and said, my $500,000 didn't grow. And I smiled. I said, no, it didn't. But you didn't lose any either. Your 401k lost $80,000, $90,000. So what would you rather have? A zero return or a loss?
What about basic savings accounts?
Well-
I know the return is so small, it's almost nothing.
Well, you need it for today's money.
Right.
To go in, you need it to be liquid and all that. But it's not for long term.
Right.
Because the rule of 72 is whatever return you're getting divided by 72, and that tells you how long it takes for your money to double. So if I got 3%, it's going to take 24 years for that money to double.
Right.
If we're getting 1%, it's going to take 72 years for your money to double.
Right. It's kind of the formula has been changed so much because people are waiting longer to have children, to start a family. So they're working longer, but some of them, their lives are different than what they used to be traditionally. What about those folks who are older but they have younger children? How do you help them with that whole thing? 'Cause that's to me, that's terribly complicated.
It is. It is. Just the financial piece and the mentality and
Yeah.
physical drain and all that, but they got to save money.
Right.
They got to save.
And so if they hadn't saved a lot on the front end.
Right, it's going to be even harder now with kids.
Yeah. Yeah.
It's definitely going to be harder. They may have to take a part-time job for other income. I mean, a business like this, you know, for income.
And what about coverage for children? Is there something out there that you recommend, or?
You know, that's a good question. When I first got started, we were always taught you don't need to put insurance on nobody that's not bringing in an income.
Right.
And, you know, back then it kind of made sense. But as I began to grow and do more research, children nowadays have a whole lot more to deal with than we ever had to deal with. I mean, you got bullying, and we got suicide. I mean, we got all kinds of stuff. You got people snatching children now. We got people going in churches shooting. They have a whole lot more to deal with than we ever had to deal with. Every child that's over 15 days old needs coverage. Now, 2 points. Not because a parent wants to benefit. No parent wants to ever deal with that.
No, not at all.
But if they did, think about what mentality a parent is going to be in dealing with that. You just can't go back to work next week. You know what I mean? I mean, you're going to need time off. You're going to need counseling. And the person still has to live. The other part of that is because we're dealing with more health challenges now with young children, we got to guarantee their insurability.
Right.
I didn't sign anything saying my children are going to grow up to be healthy their whole life. So if they get an illness and become uninsurable at 18, 20, or 10 years old, now they can't get coverage at all. So why not lock them in now when they're 1 and 2 years old? Now they have it that can never be taken away.
Right.
So we got to think bigger now, and then just worrying about death claim and things of that nature.
You have any stories of families that you've seen really suffer as a result of not having the right coverage?
Oh, absolutely. We've had good stories. We have bad stories. We had an agent on our team. His son had cancer at age 16. Luckily, he had a program, and he was able to pull out almost $50,000 using a critical illness benefit because he missed a lot of time from work. He was able to pay his mortgage with that money. You know what I mean? He was able to pay his bills and put food on the table. But if he didn't have it, you know, what would he have done?
Right.
His son is well now, and he's put the money back into the program, but you know, these things happen.
Right. And what about people who are working for you and with you? What kind of salaries and what kind of things can they expect if this is a line of or career that they would like to go into?
Well, it's not salary. It's all fee for service, commission, whatever way you want to say it. And they know that going in,
Right.
but they do know it's unlimited. There's no limit on how much you can do. I believe we train our agents not to be commission driven, but service driven. If you serve, commissions and all that will come. You know what I mean? So that's the mentality that we have, and that's the mentality that we look for.
Right.
If they do that, they can make all kinds of money in this business. Part-timers.
Right.
Most of my team is part-timers.
Okay.
You know, so it's not uncommon to see a part-timer make a couple $100,000 a year in this business. But they're working 20 hours a week.
Right. Right. Wow. Well, that sounds nice.
Yeah.
That sounds nice.
It's better than working in retail.
They must be. They must be banging
where I
down your
was.
door. They banging down your door every right.
You know, they come in and I say, here's what you can do.
Right.
And then, you know, if you don't do it, then, you know, you put nothing in, you get nothing out of it.
Okay. Anthony, what additional tips do you have for folks if they're sitting in there saying, you know, I am going to go back. I'm going to look at exactly what I have. I'm going to try to read and decipher this stuff, although it might be confusing. And then I'm going to try to take next steps. What would you say?
If you have questions, just call 301-794-4290.
Right.
Write your questions down, and then we'll answer the questions for you. But the main thing is whatever got you involved with it, just write your question and ask the questions, and ask them to explain it in a way that really makes sense where you could understand it.
Right.
And if you do that, and it may take you doing that a couple of times before you really understand it, and that's okay. That's what we're here for.
Right. I want to finish up with a question about the book, Saving Middle America. What was your hope for that book, and has it met that expectation or that desire?
The hope was to really make sure that people can really realize that it's not as hard as we make it think or make it sound, that you really can become financially independent and understanding it and doing it in a simple way. That was the main purpose of the book. not to make it so difficult where, you have to have a PhD in economics to understand it. We really had to dumb it down to where a high school student or elementary school student could understand the difference between term insurance and permanent insurance.
Right.
See the benefit of starting early versus waiting. So it has met that. As far as a book number 2,
Yeah, that was my next question.
we haven't thought about that yet.
Yeah.
It takes a lot to write a book. You've written several books, but so that's really not on the horizon right now.
Right.
But we do want to get that book into as many hands as we can.
Okay. Do you have any upcoming seminars or trainings that people can learn about?
Actually, it's funny you mentioned that. We have a seminar Tuesday
Okay.
at our office at 10210 Greenbelt Road in Lanham, Maryland. The topic of it is protecting your retirement assets in a volatile marketplace. It's not volatile right now, but it's gonna be real soon, and how we can protect your hard-earned money that you work so hard to get.
Great. Give them the phone number one more time, Anthony.
301-794-4290, and ask for Anthony Stewart, and we can answer any questions that you have.
Anthony, thank you so much for joining us this week on Think Big and for bringing all that information and knowledge and wisdom, and I thank you for the work that you are doing, because it is helping people, on the front and on the back end, to alleviate themselves from so much stress and heartache. So again, thank you for being here.
Thank you.
Thank you for tuning in. We will see you next time on Think Big.
All right.